Hey, what's up, everyone? Welcome back to Rebel Trading, where I will bring you regular trading strategies for crypto, Forex, and stocks. So before I begin this video, I would just like to say, first of all, thank you for watching. And I've got my first couple of subscribers here on YouTube the other day. Definitely made my day. I am very happy to be able to bring you guys quality content and also to help you on your trading journey in order to improve and to become profitable. As always, all the content that I'll be posting is for free. You can find everything on here for free on tradingview.com. And I also backtest all these strategies as well, just to be sure that they are indeed profitable. Some of you might have different trading strategies. For example, if you trade on different time frames or if you're trading a different asset, it's never going to be the same. So I would encourage you to also do your own backtesting before using any of these strategies. So the first thing we're going to do is we're going to go up here and click on indicators. And the indicator we're going to look up is called the Fisher transform, this one right here. So the way that this indicator works is basically it is an oscillator. It combines different forms of value and information on other time frames as well. Of course, using this indicator by itself alone is not going to guarantee you profits. In fact, I would encourage you to use other types of indicators in combination with this in order to greatly increase your chance of earning any money. So as you can see, we have 5 different dashed lines. The one in the center operates as a medium. The closer it is to the center, the more I would say that you want to stay away from a trade. So as we can see here, if it's above a 5, that indicates a highly overbought asset. Whereas if it is -5 or lower, that indicates a highly oversold position. There are also 2 different lines, and whenever these lines cross, we can see basically that there will be a reversal in momentum. So what we are looking for is for the lines to be above 5 for short or to be a -5 for a potential long position. Whenever these lines cross over, that indicates a reversal in the position. So for example, if we were to go right here and we took a long on the, for example, in this video, I'm using the Euro USD, we can potentially take a long position right here. So what I would do is I would open the trade and I would set the stop loss right below the swing low. If you do not know what a swing low is, it's basically the lowest wick for the most recent price position. So it's the one that sticks out. You want to drop it a few points below the wick so that you don't get stopped out as easily. And I'll use a risk reward ratio for a 2.0. So as you can see here, not only was the trade profitable, but it did continue to run up. So what I would encourage you to do is to take small amounts of your positions on the way up. Then if you would like to leave the trade open, you can move your stop loss up to prevent you from losing any money. And you can create a trailing stop loss so that you don't have to leave any profits on the table. Let's look for another trade. Another piece of information that I would like to leave you with is for divergences. Basically what a divergence is it is a general trend for information. So as you can see here, it peaked. And then you can see if you draw a line right here, that the momentum is slowly beginning to come down. This is what is called a bearish divergence. So the more of these that appear, the stronger the divergence will become. So for example, this would be a triple divergence for a bearish trend. So we can infer that the possibility for taking a short position would be much greater. So what I would do is I would open a short position right here, and I would not put my stop loss right here because the swing high is a little bit too much. I don't want to get stopped out. So I put my stop loss right here, a risk reward ratio of 2.0. And as we can see, we have another profitable trade. Again, I would highly encourage you to use this in combination with other indicators. For example, I'd consider using the MACD in combination so that we can get a much better entry point. So if we combine this with the MACD, we can use a similar form of strategy. We can see that the position is massively overbought and that there's a crossover in the lines indicating that the momentum is coming down. We can also see that the bearish divergence is beginning to play out. So this would be a potential position to open up your short. Again, always set your stop loss, and I would recommend putting your stop loss a few points above the swing high for short or for a swing low for a long position. Your risk reward ratio should be whatever it is to your comfort level. I would recommend, again, taking your first profit at the 1.0 risk reward ratio, and then slowly moving your stop loss down to prevent the loss of money. Again, in trading, It's not always going to be about how much money you can potentially make, how much money that you avoid losing. You always want to preserve your capital in trading so that you would potentially have more profits in the future. And again, you can try this for any time frame. I'm using it on the 5-minute time frame for scalping. It also works quite well for longer positions. In fact, I would recommend you use it for longer positions. It depends on what type of trader you are. I'm more of a swing trader or day trader. I don't do a whole lot of scalping. So as you can see right here, this would have been an excellent position to take a short. And so yeah, if you guys found value out of today's video, I'd greatly appreciate it if you would click the like button. Subscribe if you would like to see future content for trading strategies in order to help make you profitable. And I hope you guys enjoy the rest of your day.